And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show, presented by RIA Advisors.
Welcome to the Financial Fitness Friday edition of The Real Investment Show. I'm Danny Ratliff here with Jonathan McCarty, CFA and CFP. Thanks for joining us today, Jonathan. Going to get right into the numbers. Markets notch another high for the 17th time this year. As Lance says, it's today going to be another NVIDIA day, up 3%. We shall see. It's going to all be contingent, I think, on those job numbers. So we're all waiting and to see what happens here. Jerome Powell's come out, has not made a whole lot of changes as far as what he thinks will happen, but we'll get a little bit of an uptick on the CME Fed Watch that we may actually see interest rates cut here in June. So maybe not that 5 or 6 times that we expected. There's now the probability has gone up to 75% that we see cuts in June, which is interesting because we thought that was going to be that in March, or at least the market did. So these numbers have been relatively resilient. Waiting on these job numbers, what we've noticed is, you got to look under the hood a little bit to see exactly what's going on. Wage growth's not exactly keeping up. We're watching that as well. A lot happening at once. 10-year yields falling down to about 4.06. Markets, it doesn't seem like there's much that can slow this down, Jonathan. What are you seeing as far as from a market perspective right now?
Apparently it's all in on NVIDIA. That's kind of the story of the markets. And you saw that back around their earnings a couple weeks ago, where the entire market in the tech sector was dropping before their earnings reports. So much was banking on the expectations around that firm. We saw them come in significantly higher than most expectations and an immediate rebound across the space in tech. So I'd say that we're back in the volatility phase, absolutely. But that can scare a lot of people. And I think it's important to take a step back and reassess what your risk tolerances are and what you're looking for long term, and then proceed that way.
Yeah, so we're going to talk a little bit more about that here in the coming segments as far as volatility, market tops. What do you do? How do you, what type of action items should you be taking? And I think that's a big topic for many. We're hearing quite a bit about that. We're going to talk about distribution rules. I know it's something we talk about frequently here, but it is a commonly asked question. And especially with interest rates fluttering the way they have over the last several years, it has changed. But, maybe we should be changing how we look at that as well. So we're going to get into that. Inflation obviously continues to hurt retirees. We are seeing a lot happening quickly. And, mentioning that volatility, that we do expect that uptick in volatility here, especially with these markets at highs and relatively concentrated. Goldman Sachs did a study and kind of showed what happens when we do see this level of concentration. Do we continue to see this kind of scattered or cluttering of market highs all at once? And then what happens when we begin to see the rest of the market play ball, which we are beginning to see a tad bit of sector rotation in the sense that you've got about 50% of energy and financial companies over their 50-day moving average, which is promising. We've had a challenge over 2023 and really the beginning of this year is that we haven't seen market participation or market breadth really strong. And that's been a challenge, that it's been comprised last year to the Magnificent Seven. We've thrown that moniker out, and now I believe they're calling it, Jonathan, the Sexy Six. We cannot, Tesla's gone, right?
They got the boot.
Got the boot. and as Elon Musk is evidently trying to get the boot as well right now. But, so we're watching that. Now, President Biden had his State of the Union last night. I'm not sure how many of you guys watched it, but, big emphasis on increasing corporate taxes. He thinks the corporations need to pay their fair share, and fighting inflation. He has an inflation strike force that's going to come out and really battle this. And unfortunately, he's going after the corporations and inflation at once. It's going to be extremely difficult to keep these costs down, as we're continuing to see. We have over 20 plus states that have increased their minimum wage. This is going to be a challenge. And so with the amount of debt and deficits that we are running, man, kudos to who can ever figure that out. It's going to have to take well, we're not going to go there. But anyways, so Jonathan, let's kind of jump right in as far as, this 4% rule that we've heard so much about, and we're going to just kind of get started here and then finish on the other end of this. What do you, what are things that you're seeing on a day-to-day basis and having conversations with people on distribution planning and how that works?
Yeah, actually, I had a client of mine bring this up recently, and she's concerned, based off of what's going on overall in the economy, that the levels of inflation that we've seen, that 4% rule is no longer accurate. And I tend to agree with her. If you think about when this rule was created, it was created back in the late 90s, so end of the last century. It was based off of data from the 1920s to about the mid-1970s. So I think we can both agree that market dynamics have changed significantly since that time. And relying on outdated reasons around how to draw down your portfolio, it's going to be a little short-sighted in today's market. I think it goes back to what we do on the comprehensive financial planning side of being much more proactive and dynamic in our modeling of different distribution options, where we can adjust to make room for the changes that we've seen going on in the economy as far as inflation, the cost of living increases. All of that comes into play when you're looking at how long you expect your funds to last and the viability of your plan overall.
Yeah, no, I think that's extremely crucial in retirement, especially when we talk about, with sequence of return risk, with markets doing what they will do over time. How do you manage that? Interest rates changing as significantly as they have over the last, so many years. What do we do? And what do we do now that we may be potentially seeing lower interest rates? We haven't quite seen that come to fruition as of yet. And I'll grant it, the 10-year, we've seen that, kind of volatile, where it's fluctuated anywhere from, in the high 3s to over 5% just since October. And we watched that, and I think there's things that we can take advantage with that. But one thing that I hear a lot about, especially from a distribution planning perspective, Jonathan, is that a lot of people are saying, I'm going to go out and buy the 3-month. I'm going to go buy really short-term treasuries right now because I want it safe and I want to get as much of it out of it as I can. And what we fear is that could be a mistake, in the sense that we're seeing a lot of people put all their eggs in one basket and say, we're going to load up the very, very front of that yield curve. And we know that at some point rates are going to have to come down. It's a matter, it's a function of math, that we're going to see these rates at a lower place here at some point in the not so distant future. Is it June? I don't know. We think it could potentially be a little bit later. Maybe it's Q3, but at some point we're going to start to see that short end of the yield curve, which is what the Fed controls. We're going to see that at lower rates. So, what do you say to somebody like that when you're trying to build out a distribution, you're building out a portfolio to meet those needs from an income perspective?
Yeah, what we're trying to address there is reinvestment risk. I've got a lot of clients that right now are sitting fat and happy at the short end of the curve, getting, north of 4%, north of 5% in a money market. But, as we've heard Jerome Powell come out and say even yesterday, we expect to see those interest rates come down. And when they do start to change, those money market yields are going to drop overnight. So if you're front loading the short end of the curve, you're taking on a tremendous amount of reinvestment risk. If in 3 months we've seen rates drop steadily, you're not going to be able to get those more attractive yields at the longer end of the curve. You're also going to miss out on the potential capital appreciation of having those longer duration fixed income holdings in your portfolio.
Yeah, so talk a little bit about that, the capital appreciation aspect. Because I don't think that many people think about that when they're investing in bonds. They're just thinking about, I can get X amount of yield for this amount of time, but that capital appreciation or depreciation can be significant.
It can work against you if interest rates go up. So, Basically, your duration factor is determining how much capital appreciation you'll receive for a 1% change in interest rates. So as rates are coming down, you're going to see the value of your current bonds going up because they're priced to current yield to maturity.
All right, hold that thought. We're going to get back to that here in just a moment. Thanks for joining. You're listening to Real Investment Show. We'll be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
If you're nearing retirement age, what's the best strategy for you to take Social Security? And what about your spouse? Our first in-person Lunch and Learn of 2024 will look at Savvy Social Security for couples. Wednesday, March 20th at 11 a.m. in the RIA Advisors Classroom. And yes, there'll be food. Which one of you should take Social Security first? Should you both claim benefits? What about survivor benefits? The Savvy Social Security for Couples Lunch and Learn. Think of it as a double date for your money you can't outlive. Register today at realinvestmentadvice.com. Realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the Real Investment Show. I am Danny Ratliff here with Jonathan McCarty, CFA and CFP. So while Jonathan's here, we talking, Jonathan's in the field every day talking to lots of different people and trying to help them navigate retirement. And a big thing that we hear is, and we talk about, like I mentioned earlier, a lot, is how do you take distributions and how do you plan for that? And so we talked a bit about that old school rule of thumb, the 4% distribution rule, which is certainly been a challenge over the last decade or so with interest rates being much lower, but markets performing well. So the old school, super conservative portfolio for somebody who may be retired maybe didn't work as well as what they had hoped. Now, we're in this environment where we have higher yields. Now, for how long that remains, that's unknown. Also, how far do yields drop? I think that's the other unknown here, is that I don't know that we get back to these super low interest rates unless we see we fall off that proverbial cliff, which that may happen at some point. Now, the Fed and the rest of the world is trying to, well, at least here domestically in the States, we are trying to push off or eliminate a recession from the business cycle as best we can. And we know that that's, it's something that's going to be a fool's errand, I think, because at some point we have to, the numbers, the math will rule. Fundamentals will rule. We're going to have issues at hand. And you look, as we watch the rest of the globe kind of slowly, like a storm crossing the world, dip into a recession. We have Japan, just new news here that they are actually in a physical recession. We've got parts of Europe in a recession. At some point, we're going to have that too. And listen, I know a recession is scary. It's not what we want. We're going to see, people out of work. And I think that's a big thing the Fed's watching for is obviously jobs numbers, why this morning is so important. But you need that cleansing event to really let the markets and let, bring back rule of order back to some of these things. So in this environment, what do you think, Jonathan? So you mentioned, duration. I think maybe we spend a little bit more time on that. And then the appreciation of long-term bonds. So, we finished up the last segment talking about how many people are saying, you know what, I'm going to get all I can right now. We're going to invest in the short end of the curve. And while that's great, and it feels counterintuitive to maybe step out a little further because the yield curve's still inverted, which is, by the way, a very good recession indicator. Lance talks about that quite a bit. Leading economic index, yield curve's inverted, flashing yellow lights saying, hey, guys, caution. But when you're in this, so what would you recommend? Because everybody has a little bit different strategy, goals, customization needs to be done for them. But in general, if you're building out something right now, or how would you think about fixed income and getting to that 4% rule? What is that now? What does that look like?
Yeah, I think it's important to consider that you can still achieve above 4% yield on some of these 10, 20, 30-year bonds, depending on where you're getting them. And if you're sacrificing that to lock it in for a longer term, in anticipation of the rate curve coming down on the long end, that's going to increase the current value of those bonds. So if you're in a situation where you're looking at it from a total return perspective, yes, you may be sacrificing a small amount of yield on the short end, but by getting out a little bit further down the curve, you can lock in those higher yields now, because when the Fed starts to decrease rates, that's going to trickle down all the way down the end of the curve over time. And so if you're waiting, hoping to try and catch the falling knife, you may end up coming up short and costing yourself yield on the long end. It's also important to establish that duration in your portfolio before those interest rate moves take place so that you can take advantage of that capital appreciation that's going to occur in the current value of those bonds. I actually had a conversation with a client recently about this. He was concerned about going further out on the end of the curve because of the difference in the short-term rates versus long-term rates. And we had a conversation around the total return perspective of holding those physical bonds on the longer end and how you're going to get that rise in current value of that bond. So if you get in a situation where the yield from that bond is not giving you enough, you can then liquidate that and take a little bit of profit on those higher priced bonds. Essentially, think of it like this. If right now you're holding a bond that pays you 4%, and you've got that bond for the next 10 years, and new bonds that are coming out are only paying 3%, someone's willing to pay you more than what you paid for that bond to get that higher yield. So investors have different goals with their portfolios. If their focus is hitting a certain amount of income on a monthly basis, they're willing to go out and spend more to get that income coming in on a regular basis. And that's the premise behind the pricing of bonds.
So what do you think about, I hear this, and I've had people call, because we do own some long-term bonds, full disclosure, we own short as well. I've had calls saying, Danny, you guys have this bond that's going to mature in 2043. What in the world are we doing? I'm going to be 102, or I'm not going to be here. How should people look at that?
Yeah, and that brings a great point. That's a total return play, and I'm not trying to speak for the investment team, but my thought process around that is that we're probably targeting holding that bond for maybe 3 to 5 years, waiting for yields to come down on the longer end of the curve, and then looking at dispositioning that bond to take advantage of the capital appreciation that will likely result. When you're holding those longer term bonds, they have a higher duration. That particular bond that we're holding also has very attractive convexity, which is the impact of duration over the long term. So you're going to get a higher increase in the current value of that bond as rates come down than you would in other holdings.
Yeah, so that's a really good point. I think that we also need to remember that just because it says 2043 or a long duration bond doesn't mean that you have to hold it for that time frame, right? We can invest in these in many different ways as well. I mean, you can invest through mutual funds, ETFs, owning the individual bonds. We currently prefer to own the individual bonds. We typically stay away from mutual funds in general, just because we don't want to pass that additional cost on to clients. And we like the individual securities and ETFs more than we would a mutual fund, just because we're trying to keep that cost low. No sense in hiring a professional money manager and then having to pay them plus going out and hiring another money manager, maybe through an SMA, a separately managed account. We do see that quite a bit. Or those mutual fund fees, which begin to erode your overall returns over time. So, all right, we talked a lot about just the bonds in general. and locking in maybe a little bit lower yield, but getting it for a longer time, so that makes a lot more sense and you make more money. Plus the appreciations. You mentioned the duration. Yeah. Now, what about the credit risk when you're looking at bonds?
Credit risk comes into play, and I get this question a lot, whether or not we're looking at treasuries versus corporates. And, right now with where yields are at on the treasury side, it doesn't really justify taking the additional risk as far as going out into the corporate market to get that little bit more of yield. Yields are slightly compressed in that space. So we would rather have the risk-free asset, which would be the U.S. Treasury, versus taking on credit risk for an individual corporation, especially considering what many forecast to be some economic turbulence, if putting it mildly, coming in the next 5 years roughly. We've got a lot of uncertainty around what's going on with the small regional banks. That could tend to have ripple effects if that comes to fruition.
All right, so talking about credit quality, talked about the basics, right? When we talked about the bonds, and really this is kind of stemming off of that conversation of the 4% distribution rule. So if we can't use that any longer, what do you do? How do you look at distributions? When we're planning, you talked a little bit, alluded to sequence of return risk. How does that impact an overall plan, and how should people be looking at their own finances to help navigate this environment where we are seeing things change quickly?
Yeah, I think it's important to have fluidity in your financial plan and being willing to make adjustments in real time as you're getting new information and how the market's developing. If it's a situation where you're concerned about sequence of returns, then perhaps if you need to draw additional assets from your portfolio, focusing on the more risky assets to take those off the table now when we're at a time where it's all-time highs in the market. There's attractive valuations for most current holdings, although those may not come down as much as we expect. There is the likelihood that they are going to come down here in the near future. So if you're looking at trying to make up for a shortfall, it's important to identify the appropriate asset classes that would serve that goal best.
So when you mean that by, determining which those asset classes are, I think that we do need to be nimble, and we're going to talk a little bit about this. We did get a question. So, hey, if you have a question, we're trying to get to these during the show as well. So go to the YouTube channel, The Real Investment Show. Go like it, subscribe to it, help us out there, and we're going to try to get to a lot of these questions. But so as we're looking, so many portfolios are defined by the modern portfolio theory, where they say, look, here's what we're going to invest in. Here's what it's always going to be. It's going to be set it and forget it. They walk away and you're stuck with kind of what you have, right? And what we find is that when money's managed this way, that, one, I think it's a lot easier than what we do. I envy people that can put these portfolios together and walk away and say, don't worry about it. But, I think it's a challenge, and I think people are frustrated with it because they look and say, well, why am I still here in this asset class? And so you just mentioned, determining where you need to move, because what a lot of people do when they look at modern portfolio theories, they say, listen, we're going to buy large cap growth, large cap value, a blend. We're going to buy mid cap, small cap, international, emerging markets. And if we really like something, we'll overweight it just a tad bit, add a little bit of exposure. But if we don't like it, we'll remove it. And what you're alluding to is something that we more commonly do internally, which would be just maybe eliminating something that maybe there's not that conviction in anymore. Yep. Or maybe we still have a conviction, it's just not working. So we need to make a change. So how do people look at that?
Yeah, I think that's the difference of being reactive versus proactive. Modern portfolio theory is based very heavily on the efficient frontier hypothesis. It's about looking at historical returns and risk profiles of different asset classes and then combining them in the most advantageous possible to maximize the risk-reward trade-off. But that's kind of a backward-looking view of portfolio theory management. And I agree, Danny. I envy those guys that can make adjustments once a quarter and then walk away. But, when it comes to working in the best interest of your client, I think you might be missing the mark there, because just the sheer velocity of information that's coming out, nowadays that's relevant to your portfolio overall, and not having the foresight to see how that's going to impact your portfolio on a forward-looking basis is really, shortchanging your clients a bit.
Yeah, no, I agree. And what we find a lot of times, I hear from people like, well, they don't make a change unless I bring it up. And so nothing's ever really done unless I'm kind of leading that conversation or poking and prodding and saying, hey, what's going on here? Do we need to make a change? And so you just mentioned something I think has changed everything. The speed of information.
Yeah.
You said the velocity of the information that we receive has changed things, which is good and bad, because we also can now trade, at the tip of our fingers. We can make that trade. And so people can make emotional decisions based on information that may or may not be important. We did get a question on geopolitics here on the YouTube channel, Real Investment Show. We're going to answer that when we get right back. But I do want to talk a little bit more about, what's going on in the markets? How do we navigate that? Did get a question on a 60-40 portfolio. Is that dead? Keep those questions coming. We appreciate you guys. We'll be right back after this break.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
If you're nearing retirement age, what's the best strategy for you to take Social Security? And what about your spouse? Our first in-person Lunch and Learn of 2024 will look at Savvy Social Security for couples. Wednesday, March 20th at 11 a.m. in the RIA Advisors classroom. And yes, there'll be food. Which one of you should take Social Security first? Should you both claim benefits? What about survivor benefits? The Savvy Social Security for Couples Lunch and Learn. Think of it as a double date for your money you can't outlive. Register today at realinvestmentadvice.com. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I learned a very valuable lesson yesterday, Brent. You know, my wife had a really hard day at work, and she came home, and she was a little bit stressed out. And I said, well, honey, I'll take you to go get a scoop of ice cream. She said, no, I can't. I'm too fat. That's where I made my critical mistake.
The Real Investment Show podcast.
I said, okay.
Same show, your schedule.
Then I realized at that moment that I'd made this crucial mistake, which was I should have said, no, you need to get 2 scoops because you're too skinny.
At realinvestmentadvice.com.
You need some ice cream. Go eat a cheeseburger.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the Real Investment Show. I am Danny Ratliff here with Jonathan McCarty. So Brent always puts up some fun tidbits and usually words and pearls of wisdom. And one today is, I can keep my mouth shut, but you can read the subtitles on my face. So if you are in the car and you need to jump off, go to YouTube, The Real Investment Show. You can see the subtitles on my face. And Jonathan's, for that matter. It's not every day we get to have Jonathan join us, so we're happy he is here. Rich is out doing something. I don't know. Where's Rich? Gallivanting around somewhere. He's probably listening. Yeah. He's a prolific listener. Him and Lance. I haven't given Lance a hard time yet today, but I'll think of something. It's coming. So, talked about the 4% rule, what has changed with that, how he should be looking at fixed income. Markets are extended. And, one of the questions that we have been seeing a lot of, and a lot of, Jonathan deals with a lot of clients and prospects that call in. And, I think timing is really important. But, I think the mainstream media, financial mainstream media, will tell you, set it and forget it. Like funds come into an account, don't worry about it. Kind of we just talked about that most people say modern portfolio theory, we can't time the market, it's time in the market. And I'm seeing a whole lot more of these big charts of what happens when you miss the best 10 days of the market. But nobody ever talks about what happens if you miss the worst 10 days of the market. Now, granted, there is nobody I know out there. Lance can't do it. Not any, you throw a name at me who knows the exact perfect time to get out and the exact perfect time to get back in. It's not possible. And if you do, you may get it once or twice. I would say you're lucky because there's not a whole lot of shelf life for somebody that can do that and do so accurately. Because especially in this day and age, right? We're watching, fundamentals have been thrown out the window. Technicals have changed quickly. We continue to see monetary and fiscal policy change. And it has made it an extreme challenge managing money. So setting and forget it has worked to some extent. But, what we talk about and the people we work with, I mean, generally when somebody comes to us, I know, Jonathan, you probably tell them, if you're looking to beat the S&P 500, day after day or year after year in an up market, that's probably not going to happen if we're invested in, like, say, a 60-40.
Right.
That's going to be a much more difficult challenge. And should that be your actual goal? What is our goal? And so I think we need to take a step back when you think about how money is managed, because we think about it on a day-to-day basis. I think that people look at those returns. Then we look back and we look at that calendar year and say, well, 12/31, here's where I was last year on January 1st. Here's what we did. And we need to take in context the risk that's out there, what is happening, and what you need. So you have a unique skill set in the sense that you're a CFA, which is Chartered Financial Analyst, which is one of the top designations for portfolio management. Very analytical. It is, most people would say it's above an MBA for asset management, and a CFP. So we're blessed to have Jonathan here to kind of be able to talk about these things. What do you see when you talk to people about portfolio management and marrying those two together with your financial plan?
Yeah, I think, thank you, by the way, Danny. I'm a bit of a nerd. But I think when you're
I mean, your designation said it. I mean, let's be honest here. You didn't need to say it out loud, but
when you're trying to blend that, it's important to consider what, as you mentioned, your overall goals. If you're looking to beat the S&P, then you're talking about 100% equity and probably some derivative portfolio exposure as well. That's highly speculative, typically leveraged. That's a lot of risk that most investors aren't prepared to take on. So I think it's about setting realistic expectations. And I recently had a conversation with a client about, what an appropriate benchmark is for their portfolio. They exactly what you had said. And he brought up, the S&P was up this, and the portfolio is only up this. What's the disconnect there? And I said, well, that's because, you don't have 100% exposure to stock. So an appropriate blended benchmark is something that we would use for comparative analysis when speaking with clients. So something like the 60-40 you mentioned, we would use a 60-40 blended benchmark index. That's a much better comparison of investment performance and really highlights the benefits of our active management strategy.
Yeah, so that's a really good point. And I think that we look at it and you need to kind of segment your portfolio and determining how did I do against these specific things. And, we talk about the challenges that we've seen as far as, last year was a Magnificent Seven was the big driver. So if you didn't have a lot of overexposure to tech, most investors underperformed to some extent. And if you did have tech, most people were there just trying to ride it out from the big loss in 22, and you're probably not even back to even. And so, let's maybe go a little bit further into, we've talked about the set it and forget it type of portfolios. We got a question on the YouTube channel. Is the 60-40 portfolio dead? What are your thoughts there? And how should people be managing money in light of what's happening right now?
Yeah, I would say it's not dead. I mean, you look at where we're at right now in the interest rate cycle, it's a more advantageous time than ever to be in bonds, specifically in the longer term bonds. Jerome Powell now is basically not even mentioning the potential of increasing interest rates anymore. He was a little bit kind of on the fence a few months ago, but most recently yesterday in front of the Senate Banking Committee, he was only talking about when we're going to decrease rates. There was absolutely no mention of the potential of raising rates to combat rising inflation. So we're essentially at what many would consider the peak of the rate hike cycle. When that does start to occur, you're going to see that cyclical shift of it being more advantageous to have that fixed income exposure. So I don't think that the 60-40 portfolio is dead. I think that the way we approach portfolio management is the right approach. It's much more proactive. Before the break, Danny, you had mentioned that some clients come to you and say, they don't, my current manager doesn't do anything unless I come to him. If you're the proactive portion of your investment management strategy with your advisor, you're kind of not getting what you should be out of that service. So I think that having the 60-40 allocation allows you the flexibility to shift between the asset classes that are poised to do well in the short term. Having the flexibility to lever up or lever down those weightings gives you the ability to react to changing market environment.
Yeah, and also moving out of those if necessary, and understanding that, hey, we can get out of something doesn't mean we won't be able to come back to it. You mentioned, so the proactiveness, and I think another big caveat here is that we visit with different clients, and sometimes a lot of people come over because they hear and understand our asset management. Lance talks a lot about that. I mean, obviously that's his forte, and he does a fantastic job with that, where we are much more nimble from an investment perspective. But what makes our job harder sometimes is that everybody says, oh yeah, I want to plan, but then we don't get all the information. And so it is crucial and really imperative, I think, if you're going to work with an advisor and get all the value out of them, to make sure all that's done. Make sure that all that is being addressed. And, if your advisor hasn't communicated or, they have the information, haven't put it out, let them know. I think that's not a bad thing. These are things that need to be updated on a regular basis. And ideally that anytime there's major changes occurring in your life, retirement on the horizon, forks in the road, maybe potential job changes, reach out to your advisor. I mean, I think, that's something that is not done often enough. I feel like most of our clients do a really good job with that. But there's a lot of low-hanging fruit that we can help with. And so, we hear stories of somebody saying, well, I don't need an advisor until I'm ready to retire, right? I'm 55, I'm going to retire at 60. When I'm 60, I'm going to call you guys. And it's like, no, there's so much more you can be doing right now to, number one, protect, preserve, and grow. And then also, are you using all the things at your disposal properly and getting set up into retirement? Like, I prefer working with people. I mean, we work with people when they're stepping just like that, right? Hey, I'm going to retire. Can you help us? We need to roll over funds. We've got all this over here. We need to make some changes. But, I think the earlier you can help people, there's a lot more you can do. Yep. And a lot more value, I think, that can be added as well, because now we're creating that portfolio, not just of investments, but where these things are housed. Are you taking advantage of everything that your employer has to offer? Or maybe you're a small business owner. We have a Tom Allen who does nothing but retirement planning for small businesses. Do we utilize something like that to make sure you're putting as much money aside, saving as much money on taxes, but also not just thinking about taxes for today, thinking about them further down the road and what needs to be done, right? And so what has been your experience when working with somebody? It's like you mentioned, talking about, okay, what is an appropriate benchmark, but then how do you navigate that and make sure they stay on track from a planning perspective?
Yeah, in the onset of most of my relationships with clients, I let them know, think of me as your financial physician. I'm going to ask you some questions that are going to probably make you a little uncomfortable, things you may not want to answer, but the more complete information I have, the more accurate the information you're providing to me, the more accurate the recommendations I'm going to make to you are going to be, right? So, and you're right, Danny, it's not about waiting until 5 years before you're planning to retire. If we can get started in your mid-30s, in your early 40s, there's really no wrong time to start putting together a financial plan. You can have the benefit of utilizing strategies over the long term that will lessen the impact of taxes. There is appropriate capital allocation moves that we can make that will help to enhance the yield on your portfolios or the alpha generated by the strategies we employ. And all of this can be done over the term of decades rather than the 5 years prior to you wanting to walk away and hang it up. So I think that the other question that I get a lot from clients is, I'd like to know when I can retire. And obviously that's going to come into play with a lot of different variables. What type of lifestyle do you live? What type of liabilities do you currently have that we need to get rid of before you decide to retire? So having as much information as possible really allows us to be much more granular in our financial planning and analysis, and making sure that we're giving you the most appropriate recommendations to ensure that high degree of certainty of achieving those goals and objectives.
Yeah, I think that's a really good point. And so when, we talk about a 60-40 portfolio. And so when we talk about that, the first number we're referencing is stocks, equities. The last number is going to be bonds, fixed income. And so we take a nimble approach to this in the sense that, we're not always going to be at 60% stocks and 40% bonds. We have many other allocations as well. But I think a big differentiator, so somebody asked about the current allocation of that.
Yeah.
Is that allocation has been reduced as of right now. And we don't go an all or nothing strategy. It's just been, let's take some profits, right? Some techs really ran. We've had some great run up there. Let's maybe reduce exposure a bit. We're getting a little bit long in the tooth in markets, so we do expect that we're going to see a little bit more volatility. Should not be uncommon to see a 5 to 10% pullback here. And Lance has been talking about that quite a bit. We're going to talk more about that here on the other side of this break. Keep your questions coming. Go to the YouTube channel, The Real Investment Show. Love answering them. We'll be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
If you're nearing retirement age, what's the best strategy for you to take Social Security? And what about your spouse? Our first in-person Lunch and Learn of 2024 will look at Savvy Social Security for couples. Wednesday, March 20th at 11 a.m. in the RIA Advisors Classroom. And yes, there'll be food. Which one of you should take Social Security first? Should you both claim benefits? What about survivor benefits? The Savvy Social Security for Couples Lunch and Learn. Think of it as a double date for your money you can't outlive. Register today at realinvestmentadvice.com. Realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to The Real Investment Show. I'm Danny Ratliff here with Jonathan McCarty. Forgot where we were and what we were going, so I think we're just going to do small talk here for the rest of the show. I kid, Stu. I kid.
Yeah.
Maybe a little bit.
The weather's a little wet. Yeah.
It is in Houston, but hopefully, we'll dry out. I don't know. We need a little bit of rain. So, talking about portfolios and portfolio design and being able to be nimble based on economics, the kind of conditions, and I don't even know if we can say economics that matters at the moment. But just watching and following the trends of the market. And, there was an article out that, where did it go? It basically talks about why bailing on the stock market during volatility is a loser's game.
Yeah.
And there's financial advisors, which you can probably imagine where they work. Really big firm, big box. And, not to say, listen, I've got a lot of really good friends, fantastic advisors at these places. But the message is always the same. It's don't worry about the markets. It's time in the market. It's stay the course. And if you're really young, I can make an argument that probably makes sense, especially if you're contributing to funds. Now, if you can be proactive and say, look, you know what? Things are a little frothy. Maybe we should take some risk off the table. With the current funds that you have, it makes common sense to me. Like, okay, look, if we know we're going into a storm, go get your raincoat.
Yeah.
Go get the things you need to do to prepare. Where, ride it out. Don't worry about it. Don't be prepared. I'm not sure that's the best advice. But I do like it where people are continuing to contribute. That's one thing we see too, is a lot of times that we get that volatility in the markets and you talk to somebody like, whoa, I quit my 401k contribution like 6 months ago. You're like, what? Why'd you do that? Well, I mean, shoot, have you seen the market? Yeah, I have. But this is a fantastic opportunity for somebody if you're still in that accumulation phase. I mean, listen, we get a lot of people that are concerned. And I think there's a lot of concerns out there that are extremely valid. And getting all in or all out of the market is extremely difficult as well. I mean, how many times do you see somebody that, that calls in and says, hey, Jonathan, I've been out of the market since, for years it was 2008, 2009. I have not been in the market. I need to get back in. And I think a lot of those people probably made their way back in and some made their way back out. And now you're kind of, again, getting those as we're hitting all-time highs. Once again, that same deal, like, hey, I have been in cash. What do? I need to get in. You have that FOMO, fear of missing out. And that's very real. So what do you tell to somebody who's been on the sideline that needs to maybe start to step in? And yet, like we were talking earlier, it's like every day, NVIDIA's up 3%. Where do you go? Do you buy NVIDIA? Do you buy something else? How do you manage those expectations or maybe set some parameters around that, but then also around the overall allocation to models, making changes along the way?
Yeah, and I've had clients that I spoke to at the beginning of last year that said exactly that, Danny. Like, I'm not sure where things are at. I'm going to sit in cash. I said, okay, great. Well, give us a call back when you're ready to talk. And I've heard from some of those same clients at the beginning of this year that are having serious remorse of their actions. And, I sat on the sidelines all of last year, missed out on a huge year in the markets. I could have been up 20% in my portfolio, but, I was listening to, X or Y on the YouTube channels or on the TV. The Jim Cramer paradox, obviously. So, I think it's important to set expectations around what's a reasonable degree of risk. People, when they're coming into different market positions, you need to set your own comfort level. It's not going to be the same for everybody. Everyone has their own preferences towards risk and what they're willing to risk in any given trade. We take a similar approach in our portfolio management. If we're entering into a position, we're going to determine how much risk we're willing to take on that trade as well. So in having those conversations with clients, you can determine what they're comfortable with, and we can put together a strategy of how to step into our portfolios. Our onboarding process, as you're well aware, Danny, does not happen overnight. We take a very strategic approach in allocating our investors' funds into the models. We don't do it overnight. We don't dollar cost average it in over a certain period of time. That's not really giving a service to our clients as far as what we're here to represent ourselves as.
Yeah, no, I think that's a really good point as far as how do you step in where the majority of places say funds show up, bam, invested immediately, right? Yeah. Regardless of the market, regardless of what's going on. So when you're talking about this as far as putting funds to work, allocating funds, what should somebody expect? Or what, maybe if you're out there, you're a do-it-yourselfer, how would you look at this market right now? That with all the talk of, and we're seeing more and more of, markets are extreme at all-time highs once again. You do get that fear of missing out, but you also have that maybe hesitation, right? Yeah. And I think it's tough. It's difficult to manage those two. And I talk to so many people that say, they have paralysis by analysis. There's so much information out there. How do you decipher what's real and what's not?
Well, yeah, and you look at, and you mentioned it earlier, Danny, fundamentals right now are incredibly skewed. You've got AMD trading at 200 times price. 200 times price to earnings. So that's
which we own, by the way.
We do, yes, but we didn't buy it at 200 times price to earnings.
Yeah, it's like 150. I kid,
but yeah, it makes it very difficult, especially being a CFA charter holder. I'm a fundamental analysis guy, in my core. So for me to approach this and talk with clients about when the appropriate time to get in, I empathize with their concerns. They're talking to me about the same things that we're considering. These earnings valuations are incredibly stretched. It doesn't present any real entry points, but you've got to look for those pullback instances. We talked earlier about the pullback in NVIDIA around their earnings. That represented a great time to increase your exposure there, if you had the stomach for it. Seeing a stock drop $100 in 2 days, when it's already priced in the $700 range is tough to stomach. But it's also a great time to get in. And had you got in NVIDIA at that time, you'd be up sitting very pretty right around $1,000 right now. So, I think it's about determining what your level of risk tolerance is and also your capacity for risk, and then creating a strategy that's going to be unique to you around what's going to work. I've got clients that bring assets to us and say, just, get it into your model as soon as you can. I've got other clients that are more than happy to sit in cash and collect that 5% as we slowly start to allocate to our models as buy signals trigger. So it's about creating your own unique approach. That's something that you're going to be comfortable with. At the end of the day, if you're not able to sleep at night because you're concerned about your investment portfolio or the trades that we're making, you're probably not in the right situation, whether that's with us or with anybody else. And I'm not knocking any of those big box brokerage firms. I started my career at a couple of them. So, but you're right, Danny. Their approach is very different. It's, here are the funds. Let's get them invested. Let's get that asset under management up. And let's just let it ride. And there was a lot of head in the sand at times, when things are going bad. And you've got people calling in, and advisors don't really have any good things to tell them because they're not really in tune to the portfolio management strategy themselves. When you're at some of these larger brokerage firms, they have a chief investment office that pushes down their allocations, and the advisors filter that out to their clients. And it doesn't really take into account, active management strategies.
Yep. No, absolutely. Sorry, I'm trying to look here at the YouTube channel as you're talking here. So I do need everybody to do me a favor. I need to get more likes than Lance. So so go like the show. I know you're there. If you're on YouTube right now, do me a favor. Also, some good questions here. And so I'm going to try to, jump through some of these, because I did tell everybody, if you ask some questions, we're going to try to get to them. Yeah. And we do. And I think that we do sometimes in a roundabout way where we're talking about maybe more big picture items. Listen, if you ask if you should buy AMD and where you should put your stop, we're probably not going to tell you, right?
Right.
We can't give you that specific advice or recommendations. And I know Lance gets a whole lot of that on a regular basis.
I hear the SEC calling already.
Yeah, right. So I mean, we're not going to give a specific, we're talking more generalities. So remember, this is more for fun and to kind of give you an idea as far as what we think and how we do things. But what, one question here was, what do you envision, what should people expect with long-term bonds? And somebody asked specifically, if you were in a bond ETF, do you still get that appreciation when interest rates go down? And maybe speak a little bit more to duration and what people should expect with that. Yeah. Give an example.
Yeah, you can absolutely still get that appreciation when bond rates are going down. So, I mean, ETFs are basically functioning the same way that any individual manager is going to be functioning. They're buying and selling different bond issues, in accordance with their own, prospectus for the fund, number one, depending on what type of ETF you're holding, but also with their expectations around where rates are going. So, what we're doing here is basically eliminating one step in that process. If you're paying us to manage these funds, we're going to be managing them and trying to reduce the cost to you. And if it's something that we can do on a scalable perspective, we're going to take that approach. Now, ETFs also have the downfall of being subject to redemptions. So if you have, very similar to like a run on a bank, if you have a run on an ETF, they're going to need to sell their current inventory to meet those redemptions if they don't have enough capital on the sidelines. That can put losses in your portfolio or losses in that particular ETF if they're having to redeem more than the cash they have on the sidelines to cover those redemptions. So it's very similar to the same way a mutual fund functions. If you're giving somebody a pool of money to manage and they've got it invested, but then a number of clients want all their money back at the same time, they're going to have to sell those assets to meet the redemptions, sometimes at a disadvantageous time. So that's the risk you're running with ETFs, although there is definitely a bright spot in using ETFs as a complement to your portfolio, in that it allows you to be much more targeted in the overall duration of your fixed income holdings. So you can easily change between a 1 to 3 year Treasury ETF to a 10 to 20 year Treasury ETF, and you can control the duration in a much more targeted fashion with that approach. So there are pros and cons to both sides. I think that's why we utilize both. We use ETFs for fixed income. We also use individual bonds. It really depends on the goal and what our overall purpose is for that investment.
Yeah, and so more specifically to speak to that, if you have something with the duration of, say, 17, right? It's a long-term bond ETF, like a TLT. People are mentioning that. We've talked about TLT. Yep. We use that as a placeholder. We've used PLT. We've used many other long-duration bonds, individual bonds or ETFs. And those bond ETFs can be great maybe for shorter-term trading and for other opportunities, whereas, and you mentioned one thing, the redemption aspect, but also we have to think about the maturity aspect, that things are maturing. If rates are declining over time, that yield will drop, whereas that individual bond, that yield will be locked in, and you still get that appreciation. So if you have something with a duration of 5, you should expect a 5% up or down volatility based on, a 1% increase or decline in interest rates. Yeah. If you had one at 17, the exact same. And so when Lance or Mike talks about, these big returns you can see in bonds, that's what they're alluding to. But hey, thank you for joining us today. Hey, go to the Real Investment Show or realinvestmentadvice.com and go sign up for our Lunch and Learn in office if you're here in Houston. It's going to be Wednesday, March 20th. Jonathan, in addition of his other certifications, is also a National Social Security advisor. He's going to do a Social Security, savvy Social Security planning for couples. Come sign up. We have very limited spots. Do me a favor. We're trying to beat Lance. Go say you like the show. Thanks, guys. We appreciate you. Have a great weekend.
Thanks, guys.